For a lot of business owners, workers' comp insurance just feels like a cost you can't control. It's just part of doing business, right? Well, what if there was one single number, a number that you actually have direct control over that could dramatically change what you pay? In this explainer, we're going to pull back the curtain on that number. It's called your experience mod. And trust me, by the end of this, you'll see it as way more than just insurance jargon. You'll see it as your company's safety report card. Okay, let's kick this off with a scene that might hit a little too close to home. You get the renewal for your workers' comp policy, you open it up, and whoa, the premium has jumped. A lot. You're thinking, wait a minute, I haven't hired a ton of new people, my business is pretty much the same, so what gives? It's a super frustrating moment for any business owner. Well, the answer to that mystery, the key to understanding and more importantly, controlling those crazy premium swings, often boils down to this one thing: your experience modification rate. Now, you might hear people call it an EMOD, an EMR, or just the mod. Whatever you call it, it's the number that tells the real story of your company's safety. So let's get right into it. What exactly is this EMOD? We're going to break it all down, and we'll use a really simple analogy that makes it all click. Just think of it as your company's official safety report card.
Okay, so at its heart, the EMOD is basically a benchmarking tool. It takes your company's actual track record with workplace injuries and claims, and then it compares that record to the average for businesses just like yours. We're talking same industry, same state, adjusted for your size. It's not comparing a construction company to a coffee shop, it's comparing you to your direct peers. And even though the real formula is super complex, the basic idea is incredibly simple. It's just a ratio. Your actual losses, that's what your company has actually paid out in claims. Your expected losses, that's what the industry average says a company like yours should have in claims. That's it. Your performance versus the expected performance. And this visual just nails the whole concept. Your report card grade, your mod, tells insurers everything they need to know about your past performance. And just like when you were in school, that past performance is the best predictor of your future risk. So the question for the insurance company is, are you an A+ student when it comes to safety, or are you kind of flunking out? Your mod has the answer.
So what's a C grade? What's perfectly average? It's a 1.0. If your mod is exactly 1.0, it means your safety record is right in the middle of the pack for your industry. You're not better, you're not worse, you're perfectly average. Think of this as the starting line.
And here's where it gets really interesting and where it hits your wallet. If you're better than average, your mod drops below 1.0. That's called a credit mod, and boom, you get a direct discount on your premium. But if your record is worse than average, your mod climbs above 1.0. That's a debit mod, and it means you're going to be paying a penalty, a surcharge, on top of your base premium.
You might be sitting there thinking, okay, why does this system even exist? And the answer is actually pretty cool. It's all about incentives. It's designed to get away from a one-size-fits-all price tag and instead tailor the cost of insurance to how your company actually performs. It gives you, the business owner, a powerful financial reason to invest in safety and get rewarded for it. All right, so how is this magic number actually calculated? Let's dig in. And hey, don't worry, we are not about to break out the spreadsheets and actuarial tables. We're just going to focus on the key ideas behind the calculation that you can actually use to your advantage. Okay, this part is a really big deal. Your mod isn't based on what happened last month or even last year. It uses a 3-year window of your claims data. But, and this is so important, it skips the most recent year. So as you see here, the rate for your 2026 policy is actually based on your performance way back in 2022, 23, and 24. The takeaway? A bad year of claims is going to follow you and it's going to impact your premiums for 3 full years.
Now, if you remember one thing from this whole section, make it this. This is probably the most important strategic insight you can have about your mod. The formula is built to penalize a pattern of incidents. That means having a bunch of small, nagging injuries can actually hurt your mod more than one single, huge, but rare claim. It's all about frequency. Managing how often incidents happen is absolutely critical. And here's a really practical tip that can save you a ton of headaches. In many states, if a claim is medical only, meaning an employee gets treatment but doesn't miss any work, the cost of that claim is discounted by 70% before it even goes into the formula. Why do they do this? They want to encourage you to report every single incident, no matter how small, without being terrified of a huge premium hike. So report everything.
Okay, so we get what the mod is, we get the basics of how it's calculated. Now, for the most important part, what can you actually do about it?
Let's shift gears from just explaining things to taking action. This is your playbook for grabbing the steering wheel and driving that number down.
I absolutely love this quote because it just cuts right to the heart of it. Yeah, sure, market rates go up and down, but your experience mod is the one piece of your premium that is a direct reflection of your actions. It's not something that just happens to you. It's a number you build every single day. So how do you do it? It really boils down to these 4 key areas. 1. Build a real safety culture. I'm not talking about a dusty binder on a shelf. I mean making it a core value. 2. Master your claims management. When an injury happens, everyone needs to know exactly what to do right away. 3. Get a return to work program. Getting an injured employee back to productive work, even light duty, is a game changer for controlling claim costs. And 4. Be proactive. Do regular inspections and investigate accidents to fix problems before they turn into claims.
Look, following that playbook takes real work. It takes commitment. So let's talk about the payoff. Why is it so worth it to focus on this number? Why does it matter so much to your bottom line and, well, your entire business?
This is where the rubber really meets the road. Check out these numbers. We've got 3 identical companies, each with a base premium of $100,000. The average company with its 1.0 mod pays exactly that, $100,000. The company with a fantastic safety record and a 0.75 mod, they saved $25,000. But the company with the poor record and a 1.25 mod pays an extra $25,000. That is a $50,000 swing based entirely on safety performance. And listen, that $50,000 swing is huge, don't get me wrong. But the benefits of having a low mod go way beyond just your insurance bill. It's a signal. It's proof that you run a tight, professional operation. And that has incredible value out in the marketplace.
Seriously, in many industries, especially something like construction, a low mod is a secret weapon. It can pre-qualify you for big jobs that your competitors with higher mods can't even bid on. It tells potential clients that you're a safe bet, that you're less likely to have those costly delays that kill a project. And of course, it means you've built a safer, better, more productive place for your own team to work.
So that brings us to the final question, the big idea I want to leave you with. For years, we've been trained to think of safety programs, the training, the equipment, all of it, as a cost center. It's just an expense. But when you truly understand how it all connects back to your experience mod, you start to see the truth. A great safety program isn't an expense, it's one of the most powerful profit centers